All right.
Don't do that.
Welcome to episode 4 of Ink Deals. What is this, our 4th week doing this?
Yeah, episode
I
4.
think people are still listening?
No.
No? Yeah, they don't want to hear what we have to say at this point?
Probably
We've
not.
had a good run this far. Let's not mess it up, right?
All right, what are we talking about today?
So yeah, today we wanted to go over kind of the offer process and the differentiations between what I would call a strong offer and then a high offer. And when I say strong, I refer to, just that, an offer that's very strong, very commanding, and has very favorable terms for the seller. And then when I say high offer, it's just that as well, an offer that's legitimately really high in the number.
You're talking about what differentiates the two.
Yeah,
So
how one might
essentially-
trump the other in sense.
Yeah, so not every offer is a strong offer.
Yeah.
There's weak offers. There's
True.
meh offers.
Yeah, I haven't heard that in a long time. Yeah, I mean, it's, when you sell properties, for example, I've had circumstances where, let's just say for sake of argument, it's $1 million property. And I've had, an individual who submits me an offer at $1 million, but it's 5% down. It's, FHA. It's really long terms, really long escrow, someone who's maybe new to the purchase process and is a little bit shaky in their boots, if you will. And then I've had other offers that I would consider strong offers, let's say $1 million for the same, sake of argument. And it's all cash. It's, a 7-day close. It's very, very shortened contingencies, if any, and an individual that's maybe on their second or third purchase. So from a lender perspective, when you have clients come to you and say, hey, we got to figure out a way to structure this deal to make it stick and get this house. How would you educate them and kind of tell them what you think you would do?
It's very dependent on the market. Obviously being in Southern California, things are a lot more competitive even to this day.
Yeah.
So similar. I mean, you're looking at different programs and different down payments from the lender standpoint,
Okay.
which is really going to change how sellers view offers. And what you probably see is, obviously you're dealing with the contingencies and advising clients on what to put in there as being contingent and what to just avoid completely. But loan program wise is obviously a huge thing. Obviously cash is king. If you have all cash, you see a lot of it.
Yeah.
And some of these people, they're not just putting all cash down and then walking away and that's it. What they're doing is what's called delayed financing. So there are
Interesting.
lenders out there that are able to essentially finance that home after you purchase an all cash. So they may be putting up the cash or they may be giving a all cash offer.
Okay.
And then right after they're financing that purchase for them. But in the seller's eyes, they're just getting that lump sum. So obviously you have to have somebody wealthy to do something like that. But there are lenders that'll do delayed financing.
That sounds sneaky, Brandon.
It's not.
Sounds like you're trying to pull the rug out from someone. Explain to me how you delay financing.
That's exactly what it sounds like. Now, not all loan programs can do this.
Okay.
Most programs, you can't just take cash out of a property or something right after. But in the broker world, you have access to a lot more options and a lot more lenders that have creative type financing. And that's just one of the few that make a stronger offer, is because if you have the cash on hand, you can offer it and then not have all that capital tied up. You can literally take it out right after with some sort of delayed financing.
Got it.
Other than that, for most people, they're not doing that. But you have, your conventional loans, your FHA loans, your VA loans, you have your jumbo products, some non-QM products. And those are going to matter to sellers because they want to know, A, you're pre-approved. You're not just pre-qualified, you're pre-approved.
Yeah.
Underwriters looked at, or an AI underwriter or something has, reviewed income and assets and that sort of thing. Down payment amount is going to matter. 5% versus 20% or more, Typically, do you advise sellers that, take an offer if it's comparable that has more down than not?
I mean, it really comes down to vetting the buyer. So if you're, listing agent like myself and you're presenting your client with multiple offers, which is always a good thing because it shows the house is, very highly sought after. You basically want to, what I would do is reach out to each of those individuals who has written an offer. If it's been being represented by an agent, talk to the agent, ask them hey, is your guy legit basically? Like, is his
Right.
debt to income ratio solid? Does he have, kind of a wishy-washy sense? Have you been writing offers on a bunch of properties?
Yeah.
Have you fallen out of escrow on any properties?
Proof of funds is a big
Exactly.
one too,
Does the
right?
guy have money? Does he have 15 car payments? Whatever the situation is, you need to get to not only the fundamentals, but basically like the brass tacks is what I call it, and understand exactly what the motivation is for that individual and if they have the ability to buy the property. And then once you kind of create a story for each of the clients, then you basically, project that to your client, the seller, and say, hey, this guy's rock solid. He's got one car payment. He's got a family of 4. Everything else is paid off. He wants the home. This is the only property they're writing an offer on. They need to get it. They're willing to put down more money if they need to, et cetera, et cetera. So to kind of piggyback off of that, when you have a buyer come to you who you're writing a loan for them and they say, is it smarter to put down 5% or 25%? Because I need to get this house. How do you kind of explain to them which is a better way to go?
I mean, it's similar. If you're talking
Yeah.
to someone that's, bidding on houses that are in that really competitive, I mean, everything's competitive here, but especially that, 800,000 to 1.5, which is
Yeah.
an average house in Southern California.
They're not
Very,
in Kansas anymore.
very competitive market. So you want to make it as strong as possible. And
Yeah.
typically, the more down, the better in that regard. But
Okay.
that's where loan program comes in too. Like,
Makes sense.
lots of sellers will go for a conventional loan over an FHA or a VA loan. And it's not so
Okay.
much necessarily the financing, although typically most people with good credit are going to be leaning towards
Yeah.
a conventional loan. Unless they're veterans, then they'll go with the VA.
So, and correct me if I'm wrong, but an FHA loan is generally 3% down. Anything conventional, I mean, you can put anything over 3%. So 5, 10, 15, 20, same increments of 5%.
Generally, so 3.5% is generally the FHA down payment. Now, there's programs where you don't need a down payment and you can have like a small second mortgage. And
Interesting.
the 3.5% down, so you're literally 100% financing on FHA.
Got it.
Again, it's not typical, but they're out
Yeah,
there.
yeah.
Conventional, there's a lot of lenders now that are, 1% down. Some of them are using down payment assistance programs
Yeah.
and that sort of thing. But those are what's going to separate those offers and make them weaker. Although for buyers that need it,
Yeah.
obviously it's a great thing. But if you're using a down payment assistance program, and say you're offering 700 grand for this house, and you're putting the bare minimum down using down payment assistance, and you have another offer almost the exact same with 20% down,
Yeah.
9 times out of 10, that seller is going to go with the down payment because
Obviously.
they don't have to deal with that down payment assistance program and if it's going to take longer and if they're approved or
Yeah.
not with this program. Is it a grant, like second mortgage? It adds more layers
Yeah.
to it. And sometimes,
So
layers aren't necessarily a good thing when you're buying.
it overcomplicates it and it just stacks and stacks and stacks. So scenario for you. I'm an agent. Your client is coming to me to buy a property I have listed. They are an FHA, 3.5% down. They, obviously they're not really sharing a lot about their finances, but I've seen what they're making. I see their debt to income, things to that degree. And then I have another offer. It's conventional. It's 25% down. That one is a little bit lower in price than the FHA one. As a lender, how would you pitch me as a listing agent to accept your client's FHA offer over this higher down payment offer?
Right. And that's the thing. Obviously, you want to highlight that it's a higher offer.
Yeah.
Is really all you can lean into, and maybe you've done your due diligence and gotten him
Yeah.
qualified, and maybe explain why he's going FHA and not conventional. Whether it was something happened in his life and there was some health bills or something that hurt his credit a little bit, and he's instead
Okay.
of being a 740, he's a 640 or something, and so
Yeah.
kind of paint that picture. Another thing to consider when you're purchasing with FHA or VA is kind of the state of the property. So another reason why sellers may not choose the government loan programs is because the appraisals have more of what's called subject to conditions.
Interesting.
So
Okay.
I don't know if you've dealt with this, but like if you're buying a property with a conventional loan, conventional financing really just assesses the property value. Is it livable? And that's that. FHA and
issues.
VA will find, the appraisers will find and have to notate
Yeah.
a lot more issues. And depending on the loan, if it's not like a 203K where you're doing rehabs, they'll have you fix them prior to that transaction. So it can complicate things with sellers and getting homes sold that maybe aren't in great condition.
So what you're saying is, to kind of break it down in more simplistic terms, if you have a house that, let's say, is just a total pile of crap, it's got broken windows, you know, the roof is questionable. Well, let's not say broken windows, but it needs work. Maybe it has some termite, maybe pieces of the roof are falling off, you know, it's scraped and bruised, bumped and all that. As someone looking to sell that house, me potentially, I would be very weary of an FHA offer because of the condition of the property.
100%. Yeah. Unless you are wanting to fix that, there's going to be...
You're going to have to ask for credits. And then essentially at that point, the lender's going to come back and say, hey, listen, man, this isn't even like can you fix these things? It's like, no, you have to, or the deal is dead. We can't finance.
Yeah.
It's not going to work.
They're using one of those loan programs. So if you're buying anything that's distressed or needs a lot of work, you're going to go either conventional or you're going to go with like a fix and flip type loan or a renovation type loan.
Or even a hard money loan or something to that degree. And for everyone that's listening, you know, a hard money loan is generally like Loan Shark. Basically someone who's not a bank, they're not a lender, they're Joe Schmo who's, you know, a multimillionaire, says, hey, you know, 10 points, I'll give you $1 million or whatever, 800,000, whatever it is.
Yeah, you know? Kind of. I mean, it's not like a Loan Shark. I mean, there's hard money, there's private money, there's different qualifications.
Yeah.
So there's
always higher interest rates. Always higher interest rates. Because it's for people that can't get conventional normal financing.
Typically. I mean, there's still loan programs out there that are like 1099 based, bank statement based, asset depletion, and the interest rates aren't a lot worse or anything, but they're not as low as conventional.
Yeah.
They're not Fannie Freddie backed loans. But that's not to say that like every hard money or private money loan is bad. It just depends on the scenario. And some of them, like if you're doing investment properties, and DSCR is super popular, where it's like a debt service coverage ratio.
Okay.
If you're doing investment properties, you don't have to worry about like your debt to income ratios and all that jazz. You literally just take the rent versus the expenses and qualify it based on there. And usually they're interest only. So if you're getting cash flow monthly, it can help your cash flow because your payments are going to be
low. You've talked about a lot of different types of loans. You know, very confusing to a first home time purchaser, even maybe a second or third or even an investor.
100%.
So with that being said, what do you think are the top 3 types of loans that are the most utilized in standard residential purchases? We're not talking about fix and flip. We're not talking about multifamily income producing ones, just standard residential. I mean, what are the top 3?
Conventional is going to be number 1, especially in Southern California. You know, let's talk about where we're at. You see conventional financing all the time. You see jumbo financing, which, you know, isn't necessarily non-QM, but can be.
And with conventional, people are always worried about, you know, mortgage insurance. So as long as you put down 20 or more %, you're generally not going to get hit with mortgage insurance.
Yeah, and there's other ways around it too. You can do lump sum, and you can get credits from the seller for it. So there's different ways to handle the mortgage insurance. And then FHA, VA are your other 2, you know, standard loan programs. But
VA sounds cool. What does that mean?
It's for veterans only.
Oh, so unless you have to serve in the Army, basically Navy, whatever, and then
active.
I think
or past duty.
That's 0% down, isn't it?
Can be.
Yeah,
can be.
Okay, cool.
Yeah.
And when you are utilizing a VA loan with a 0% down payment, are the interest rates really high?
No, not really. I mean, there's what's called loan level pricing adjustments based on a lot of different factors: credit score, loan to value, type of property, all that kind of stuff. Which, you know, talk with your lender about. But no, it's not, especially with VA programs, those kind of adjustments don't really happen so much with the amount you put down. So
Got it.
There's going to be, you know, slight, but it's not going to be like a
astronomical difference.
Yeah, it's not going to be like a full percentage difference or anything like that.
So I know we spoke about when we first started contingencies, and, you know, I wanted to speak a little bit on that because I know those are very, very important when it comes to submitting any purchase agreement on a property, right? Whether it's commercial, residential, duplex, fourplex, income producing, whatever. So for our viewers, essentially, that don't have any idea about a purchase contract, the 3 most important pieces, in my opinion, are your contingencies: your loan contingency, your appraisal contingency, and essentially your home inspection contingency.
Right.
And the way that I like to pitch it is those are basically like your protective barriers to ensure that your deposit, which is generally... Well, it's generally between 1% to 3% of the purchase price, but you can literally put a deposit for any amount. I never have a client generally go over 3% unless it's being requested by the seller and it's some sort of caveat to getting the deal accepted.
There's a lot of offers.
Yeah, and because it in essence, it's called an earnest money deposit, and it makes it look like you're more serious. You're basically saying, hey, I want this house. So to kind of circle back, those contingencies in essence are your protective barriers that protect that earnest money deposit.
They allow you to pull out of the deal if something
happens,
isn't working, whether it's the financing or the inspection. There's stuff that goes bad on there. It gives the buyer
peace of mind as well,
right?
And it protects you because in essence, it's like I said, a protective barrier. And I know, for example, when you have your appraisal contingency, really all that's saying is that the house has to appraise for the value that the purchase contract says. And if it doesn't, one of two things can happen. You as the buyer can go back to the seller and ask for a reduction to meet the appraised value, or you can essentially make up the difference. Now, do most buyers want to make up the difference in a market that's in their favor? Absolutely not.
Yeah.
Now, if the appraisal is over what the accepted purchase price is, it makes you look like a stud because you basically got a deal on the property. So appraisals can be very interesting in that sense.
Yeah.
Now, when we look at loan contingencies, essentially the way that I would explain a loan contingency is basically once your loan goes through underwriting, which I consider like the FBI of the loan world. They basically run through everything, make sure, you don't have a boat overseas somewhere and an account in the Cayman Islands and this, that, and the other. They want to make sure everything is legit.
Yeah.
They run all your background, et cetera, and they give you that stamp of approval. So once those two contingencies are met, then they can be removed. Now your last contingency is essentially your home inspection contingency.
Major.
That's one of the most important in my opinion, because at that point, you're bringing in an inspector, you're doing a general home inspection, you're doing a sewer inspection, you're doing sometimes a chimney inspection, you're doing a termite inspection. You're literally tearing the house apart within reason to understand if there are any hidden bones or any issues with that property.
Yeah. So the buyer knows what they're getting into. Hopefully, you have a good inspector.
Hopefully. And then, essentially, if you find anything wrong with the property, you can go back to said seller and say, hey, buddy, I want 20 grand back because your pool's got a leak in it and your roof's got a hole in it and your flipping drywall's got rotten and da-da-da-da. And then it's like, now you can generally do one of three scenarios. You can have the seller repair the items prior to the close of escrow. You can get a reduction in the purchase price, or you can have them give you seller credits. Generally, the way that I always have it done, because these repairs can take a very long time. So if you only have a 21-day escrow and you're 15 days in, it's like, no, the sellers aren't going to get a guy out there to fix everything. So just get a reduction in purchase price because it helps you on your property taxes, because now the value of the property is lower. If it's 20 G's, lower the price of the home 20 G's, and now your property taxes are 20 G's lower.
Well, yeah.
In a perfect world.
The property taxes are 20 G's lower.
Well, no. The purchase price, which would lower it because it's calculated.
Lower amount. Yeah.
So when you pitch it that way, people are like, where do I sign? Right?
20 G property tax.
Wow, that's astronomical. So yeah, I mean, that's, in a nutshell, I think the most detailed version of how a purchase contract is and how the offer system goes.
And what we saw a lot over the last couple of years when the market was like fire hot, people were just waiving almost all of those contingencies.
Blind offers, baby. Selling stuff via Facebook and
forget the inspection. We're just purchasing this house and then finding out about everything later. So those contingencies. Right. The more you have, the more hassle it is for the seller, but it also protects the buyer. So the key, would you say, is kind of finding like the middle ground and what's going to protect your buyer?
Yeah.
If you're the buyer agent.
Yeah.
And if you're a listing agent, you're trying to find the offer that has kind of logical contingencies, if any. I mean, obviously, it's possible.
Great question. And I get asked that a lot. I obviously go through it a lot with my clients, but it's really a negotiation. It's a back and forth conversation between your client, who's the seller, and their client, who's the buyer, or vice versa. And you basically have to come to a meeting grounds where everyone is happy. Now, do you always get everything on your request for repairs, which is actually what it's physically called, the form? No, but are most sellers and buyers ethical, Normal people, yes. Well, in most terms. And so the point of it is we're all working together, right? The seller and the buyer are working together to come to agreements to get the deal done. So it's in their best interest as a collective for all of us to agree on something. So the way that I always pitch it is like, whoever you're representing, whether it's seller or buyer, your client wants to feel like they've won. They've won something.
Right.
So if you come back to me and say, hey, great news, man. I got us $10,000 in repairs. But initially you'd ask for 40 and you just leave it at that. Generally your client's going to be like, all right, well, we asked for 40. And you go, yeah, I know. Hey, I totally understand that. But there's 7 other offers on the table. And it's ultra competitive. And they're literally giving us 24 hours to respond. So it's either kind of, pardon my French, shit or get off the pot. Do you want the property or not? Because there's nothing else on the market. So you've just got to frame it. You've got to create a story, like I said earlier, and you have to frame it depending on what the market's doing. But that's generally the way that I approach it. I'm like, hey, let's get the damn thing done.
Yeah, especially around here, you don't have months to.
No, hell no, man.
Forth. These things are still fine.
You just got to move forward, man, and get it done. And I think, most people are logical, right? You've already gone through, let's say, a 30-day escrow. We're on day like 21 and we're making this last negotiation. Like, very worst case, if no one can come to an agreement, you go back to the drawing table and now the property's back on the market and you got to redo this whole thing again.
Yeah.
Sometimes selling a home can be a nightmare with all the ups and downs. And, I got to be out of my house every 20 minutes for someone to see it and open houses and yada, yada. So
yeah, it's a pain.
You got to frame it as well. Like, hey, do you really want to go through this shit show again or do you want to call it a day?
Yeah.
Yeah. So.
Different ways to get it done.
Different strokes for different folks, right?
Yeah.
So, well, yeah, I mean, that's, offers, that's perfect offers,
Really,
bad offers.
Yeah, it's really just the tip of the iceberg, but, a lot of things to consider for both buyers and sellers is contingencies, loan program.
Pay attention, get a good agent like myself, get a good lender like Brandon, and ensure that you work together as a team to reach the finish goal.
100%.
That's it.
Cool, man.
Cool. Well, thanks everybody for tuning in. Same time next week.
Yeah.
Do we even have a time?
No.
Okay.
But let's say yeah.
Yeah. Okay, great. We'll see you guys next year and next week.